Good morning, everybody. It's Chris here from Serene Education. Just going to be going over the 4 majors analysis update for the first week of November, November the 2nd to November the 8th of 2014. Starting with the euro against US dollar, let's have a look at the monthly. So we know the overall movement here is to the downside, has been quite aggressive over the past 6 months or so, and we know that the likely target is going to be towards that institution moving average down here at this green line over here, primarily because we've seen major support and resistance level at this particular area. Whether you go on the institution moving average down here, roughly the 1200 and 158, take it to the 1200 level, but ideally you're going to start seeing price heading towards that institution moving average. Looking at the fall, we've now gone into November. You can see October, we had a slight pullback to start with during the first part of the month. However, the closer we got to the end of October, that negativity started to play through. And if we drop down to our weekly time frame, you can see that hesitation over the close of October, in fact. So the last week, going into the end of October, going into the first into the November start, you can see that we had a pullback over that month in particular. So price, if you look at fib projection, fib extension or retracement levels, you can see that we had a high here at the start of this year, in fact. So we can take those highs to the current low that we saw back here in May of 2012. You can see the resistance level high, so that'll be 100%. You can see prices pulled back now from that 100% back towards that zero level that we saw back here in 2012. And you can see that the 23.6 level, the 1249, happening to be a major support level in the past. So that on our daily time frame is going to be a daily 4-hour, etc., leading into our smaller time frames. That's going to be the level we need to see price closing aggressively below going into the new month, November, this first week of November, to see if we can see any further continuation patterns down towards those major support and resistance levels we saw on our monthly, which happens to be that institution moving average, roughly around, I'd go for roughly around the 1200 mark as a round figure. But be aware, guys, this is the first week of a new month. That means we have non-farm payroll, which is a very, very important piece of data, but we also have a lot of data that leads up into that Friday, the first Friday of the new month. And Thursday in particular, we have a lot of news, especially for sterling and euro. We have the interest rates announcements for both those currencies, and we also have a lot of data that comes for unemployment claims. On Wednesday, the 5th of November, we have the ADP non-farm payroll employment change figures for the US market. So there's a lot of data that heads into the non-farm payroll. So expect a lot of volatility, a lot of speculative volatility to occur from Wednesday leading into Friday. So straight away, we know what our requirements are. You can see the indicator box here on my FX8 template. You can see quite clearly very negative indeed on my monthly, my weekly, my daily, my 4-hour time frame. You can see the R squared is complementing that negativity, so we should be still looking for selling opportunities on our intraday time frames. So now when I look at my daily, my 4-hour, I need to see price making new lows to be heading with that long-term support and long-term trend directive. So into the daily, you can see that the start of October, we saw a consolidation pattern here, a nice morning star formation. In fact, a nice morning star. Price reverted to the upside, got back above the 38.2, but failed to actually kick on after this hammer formation above that level. Failed to see the kick on towards that 50% retracement level. We had a bearish engulfing candle, which pretty much didn't bode well, almost a really weak evening star formation, but we did get a bearish engulfing candle here, back below this level. The candlesticks, however, and this is the most important part about this actual template, you'll notice that on my daily, the candlesticks are still primarily red, even though when we had this consolidation pullback after price headed into that weekly fib level, 23.6 level. Notice even though we had a blue arrow which constituted that we should be looking for potential consolidation, you'll notice that the candlesticks never change color, and that's primarily what we want to see from this particular template. It's got to be mechanically driven. So the requirements, the 4 core requirements that you need to see are the arrow, the candlestick, the RMO, and the OSMO all working together, depending on which time frame you're looking at. Ideally, looking at the long term to see where the bias lies, etc., and then working your way intraday. So here, if you're looking at the daily, for example, for an opportunity, you'll notice we have a blue arrow. Okay, perfect, because we've seen consolidation at a major support and resistance level. Happy days. However, we want to see the candlestick now moving with the color of the arrow, but in this case it's still red. So we're just seeing consolidation in a negative trend, and primarily that's exactly what we saw. We saw a very, very extended consolidation through October. In fact, the RMO is still below the zero level, so it's still telling us we should be looking for negativity. The OSMO was the only thing over here that actually counter balanced this negative stuff. So we had 3 negatives to 1 positive, which was the OSMO. So sorry, there was two, so because we had the blue arrow. Apologies. So we had a 2 versus 2 positives, 2 negatives, which cancels each other out. And what we wanted to see was a return with negativity, with trend. And the trend we know for euro against US dollar up for the last 6 or 7 months or so has been negative. So therefore you want to still look for sell. You want to sell with long-term sentiment, and that's what our directive is right now. However, you'll know though we're trading at a major support and resistance level. The support and resistance level that we saw at the end of September going into October. So it's vitally important that we actually see price closing lower than that. Otherwise, we could see another hesitation or another correction bounce here, and we could see price heading back up towards that 38.2 for this week. So it's imperative that we are to see further negativity for euro, because we're seeing long-term sentiment moving lower. We need to see a daily close low in this level to constitute that we're seeing another swing low with long-term sentiment. Therefore, we can get back into this trade, and we can look towards the zero level, which is down here at 12015 and change. And looking at that particular level that we're trading right now to our potential target to the downside, there's an excess of 453 odd pips. We're not going to get all of that, but there's more than enough on tap for us to make a genuine return on time invested. Moving on to sterling, here you can quite clearly see that price failed to make any new lows over the years since 2008, in fact, but we failed to make any new highs, major highs, also through that time frame. So we were pretty much trading within a consolidative range, but we were making less lows, and we were reattempting the highs towards going into 2014, in fact. And we had a nice breach of the institution moving average, which happened to actually trap price over the years. You can see the institution moving average, this little green line where I've drawn my horizontal line now. That was where the institution moving average was, and you can see that price actually failed to get above that level convincingly, and we've had pullbacks over the years at this level. However, going into 2014, we saw a lot of positives coming out of the UK market, which then pushed price higher. Unemployment was dropping, employment was rising, interest rates were capped at the same at 0.5. We saw a lot of stimulus in the market there. We had a quantitative easing plan working quite nicely. However, the only thing that didn't really work well was the fact that even though we had a lot of liquidity out there, we noticed that even though we had employment figures that were going high and unemployment was dropping, the rates of salaries was not rising at the same time. So there was a bit of indecision there, and subsequently what happened was we also had a lot of indecision coming out in Europe, which also unfortunately has a knock-on effect with sterling, because we are such close allies and we do a lot of import and export with each other. Eventually that happens to reflect on sterling in a negative stance because of our close relationship, and that's primarily what happened. We saw price pulling back, failing to actually find support at that 16,700 mark, and we saw bearish engulfing counter close lower, and subsequently over the past 5 months, in fact, we've seen pullbacks, sharp pullbacks for sterling against the US dollar, and we see a lot of positiveness coming out of the US dollar, in fact. You can see that on our indicator box. That's primarily exactly what's happening now. Our monthly, weekly, daily 4 hour is looking negative and has been negative over the past 5 months. Therefore, we should be seeing that as a noticeable indication on our chart, our indicator chart. So when we do is we look down to the daily time frame, you can see we had an extension, a nice support level forged at a certain period right down here, around about the 1481 and change mark. You'll see that price failed to make any new lows, therefore making a nice support. The OSMO was starting to build aggressively here. It wasn't, even though we were in a negative move into the tier, you can see the OSMO was primarily above the zero, so telling us we were seeing a bit of building or a change in market sentiment through this period here, and subsequently we saw this bull move for sterling against the US dollar through June of 2013 all the way up to the highs here in July of 2014. So we have a potential pullback. We have seen price pulling back, therefore I can use my fib retracement levels. You can see that we had a lot of support and resistance level around that white line, and that white line constituted to my monthly institution moving average. So therefore you can see we saw a lot of hesitation, because people trading longer terms will be well aware where their institution moving average is on a monthly, and you see a lot of hesitation in and around this area. And once we broke back below that level aggressively, that told us that there was no further buying sentiment for sterling against a very strong US dollar. Therefore, we should be looking to the downside, and we should be tackling the 61.8 as a potential target, back towards the institution moving average, which is our 50% retracement. And you can see now we've got to the 50% retracement, which happens to be a price support and resistance level in the past as well. You'll notice we've seen a lot of hesitation. Like euro against US dollar, the past month, in fact, we've seen a lot of hesitation, a lot of spinning doji candles, and we don't trade indecision. When you start seeing these candles over here with very, very little trading volume on the candle, it's telling you that the buyers and sellers are clearly at loggerheads. Therefore, we should stand aside. Wait for a directional candle. And last week's candle was direction as bearish engulfing. It engulfed the prior 2 weeks, and it's retested the support level below that institution moving average, and it happens to be trading just below the 50% retracement level over here at 1600. 1600, nice psychological round number again. Traders like round numbers. I don't like really working to the nearest digit. It's far better to look at a psychological round number. So daily, working towards the remainder of this week, we want to see sterling remaining below the 50% level, below the institution moving average on our daily, below the 1600 level in our intraday time frames, to show us that we should still be looking for negativity, because we know the long-term sentiment over here recently has been negative. Our indicators are telling us we should be looking for selling. So therefore, on our daily, we should see the candlesticks being all red, and they are. Okay, we're still seeing swing lows. We saw a lot of consolidation, but we're not seeing any new swing highs, which is indicative of any change in market sentiment. You'll notice all my moving averages above price, which is also negative. RMO below the zero level, which is negative. OSMO is below the level, negative. Red arrow, red candle, RMO below, OSMO below. So we are looking for negativity. The only thing that's against us at the moment now is if you look at the candlestick itself. There's not a lot of volume in that candle. There's still a lot of indecision. However, it's still below a major support and resistance level. It's still below a fib level. Well, the 50%. It's not actually a fib level. It's just a halfway line between 100 and 0. However, it's still below those levels. It's not making new highs. So there's a lot of negative. There's more negative apples in our basket than positive apples. So I'm building a picture. So I'm still looking for negativity. So, and I'm giving myself a lot of directives. Everything's negative, therefore I should be looking for selling. Okay, so that's what I'm looking for, my 4 hour, my hourly, etc. I want to be selling with price. I want to be moving with long-term sentiment, which is to the downside in this case. So I look at any fundamental news out there that could actually move price in favor. So I'm looking for any negative sterling data. I'm looking at positive US data this week to actually help that. Okay, so that's my objective for this week, is to look for further selling bias, look for price to maintain below 1600 in particular, and look to see if we break any major support and resistance levels so we can target our next level, which will be the 38.2 level on this particular chart, which is in excess of 265 pips to that level. So there's still money to be made from price, as long as we get price moving in the right direction. You'll notice on the 4 hour time frame, we've seen a consolidation over the Asian session. See a lot of hesitation here on the Asian session. We had I think Japan's got a bank holiday today, if I'm not mistaken. Yep. So not a lot of liquidity overnight on the Asian session. Sterling has not made any new highs on the 4 hour time frame. You can see on the 4 hour over here, everything is negative. I'd like the R squared to complement that negativity. It's not going to happen at the moment. I've still got another 36 minutes to see this candle close. Ideally, it's got to be bearish engulfing for the R squared to complement that selling, because everything is selling. I should be looking negativity. Then I could start looking to the downside towards that 200, so the 38.2 level, which is down here at right about 250 odd pips away. US dollar Swiss franc. Monthly, we should see the total opposite. If euro US dollar is very negative on the monthly, you can see that all red, and the R squared is complementing the negativity. US dollar Swiss franc should be all blue, and the R squared should be blue to complement that positive, because we've seen almost 6 or 7 months of upside. Candlesticks, however, you can quite clearly see are negative. Okay, on a major time frame like this, you'll see that we're not making any new highs. In fact, we're actually trading right now. If you look at it, price is trading at a major support and resistance level high. Here, a lot of support through 2008, 2009, going into 2010. And from 2010 onwards, we've seen resistance in 2011, 2012, 2013 resistance. So price support has become a new resistance. Therefore, this level around here at the 96, around about the 1000 mark, just below the 1000 mark, has been a major support and resistance level, because price has hesitated here in the past as support, and price has hesitated here near term as resistance. Okay, so you have to be well aware of those levels. So when I look at, we had an all-time low here in 2011. In fact, I can take those lows to the current high that we saw way back here in 2000. So this is my monthly fib levels. All my fib levels are color coded because I'm looking at a monthly time frame, therefore they're blue. If I look at a weekly fib, then they are in red. So now if I just zoom in, you can see that I've taken the 78.6, which is fib level, and the 76.4. I've noticed a lot of people also use that level, and I'm getting a lot of people asking which is the best. Ideally, the 78.6 is a fib level for genuine. It is a fib variant. The 76.4 is not so much, but a lot of people tend to use it. So what I've done is I've actually incorporated it into my fib levels, because if price is trading in and around that area, you'll find there's a lot more consolidation or hesitation between those 2 points. And if that just makes sound sense, you're gonna find a lot more hesitation at those 2 levels. Therefore, you're gonna see price becoming more of a consolidation around those areas. You can quite clearly see between those levels, we've seen price supporting here in the past, and we've seen price resisting in the past. So between those 2 levels, that becomes my no trade zone. It's my Bermuda rectangle of trading. Don't trade inside there, because there's a lot more speculation, there's a lot more volatility, and it just it's not worth it. I'd rather see if price gets above that, then I should be tackling back up towards the 61.8 level. If price remains below that, then I should be looking back to the downside. Okay, that's the way I use it. You'll notice that the bounce here to the correction high, I can use that as my weekly fib level now. So that's what I'll do. Okay, and because it's a fib level, my weekly, I change that level to show in red, so I know where price is trading and what the levels are. So therefore, I've got my monthly fibs in blue and my weekly fibs in red. And now if I drop down to my weekly time frame, you can see that price is still trading within that consolidation, that the Bermuda rectangle. You can see a lot of hesitation here over the last month. Like both euro and sterling, we had a lot of hesitation through October, and you can clearly see that happening. And you can see in the past, we also had a lot of indecision, a lot of upside movement followed by downside quite aggressively. Not the best areas to be trading, because it's so there's so much speculation, and it's not directional. Okay. However, you can see though that my indicator box is primarily blue. We know the US dollar has shown a lot of strength against most of its cross pairs. Therefore, we should still be looking for bias to the upside. Even on the pullbacks, the bias, because it failed to change color, we should still be looking for the up. So now if you look at the weekly time frame, we're looking for the arrow. The last arrow we had was back here in March of 2014. The candlesticks were red. However, the less lows we saw, the more highs we saw, the more we saw bias starting to change to the upside, and eventually that was the case, and you can see prices moving higher. So now, if we know that the bias for US dollar is long-term positive recently, therefore we need to see price making new highs, and you can see that we haven't seen a new high recently because prices failed to break above the 76.4 level over here, resistance level in the past. And even October, we failed to see any new highs in October. So it's vitally important that we see going to November a new high. Failed to see a new high, that means we're going to see further consolidation, and we could see price trading between these 2 levels, which is going to lead to further speculation, further volatility, further risk attached to any market, your money management, which is pointless trading. So my daily, etc. to the downside, I want to see new highs being forged as soon as possible. So ideally, I'd like to see a close above the 0.97123 level, at least a nice bullish engulfing candle. You can see on my daily I have a blue arrow. Candlesticks are already blue. My RMOs has been above the 0 level since the start of July, in fact, and my OSMO is above. So everything is telling me I should be looking for buying. You can see on the daily, everything is nice and blue here on my indicator box. However, I don't have a new high. That's what I need to see. Okay, a lot of indecision. Need to see a new high. Then I can target ideally towards my 100% fib level, which is a good healthy 269 pips away. I'm not going to get all of that, but I'm going to be able to see a little bit of that, a large chunk of it, ideally at least 150 to 120 pips of that going forward. Last pair of the day, US dollar Japanese yen. We've seen a lot of strength for the US dollar, and that's primarily what we're seeing now playing out on the US dollar Japanese yen. You can see the all-time high that we saw recently on this downtrend through 2007 to the current lows through 2011. We saw a lot of support through 2011, and then we saw the building through here, and you can see prices heading to the upside. My indicator box is primarily blue. There's a lot of indecision in intraday on my hourly, 30-minute, 50-minute. That's not really interesting in my particular case. If you are trading intraday, that might be the case. You'd like to see all that. However, the bias over here is clearly to the upside. You can see the month of October, we saw a lot of negativity to start with. However, by the end of play, at the end of last week, in fact, we saw that bias heading high. This is even after the quantitative easing plan was taken off the table in the US market. We've still seen price moving higher with that. So that's a good sign, because a lot of quantitative easing, and the Fed was going through a quantitative easing plan, pumping a lot of money into the market. It's good for the Fed now to pull it all away to see if the market can actually hold itself above the waterline on its own, because that clearly tells you that there's genuinely a positive bias in the market. Therefore, it's going to be good for the currency, in this case the US dollar. So we should be looking at the S&P, the Dow, etc., the Nasdaq, all those type of things moving high over the next couple of months. Ideally, if we are to see further positiveness from the US market. So monthly fib, we can take the current low to the current high. So the low in 2011 to the current high that we had in 2011, the lows to the current high that we saw in 2007. It's a monthly fib, so that's got to be blue. So I'm just going to change that. There we go. And now you can see that the 23.6 level on 11269, price trading straight into that level on my monthly. Didn't even close a higher. Fib levels are fantastic, because you can see prices being using these levels, because a lot of people are using fib levels to trade with. You can see in the past how it's actually helped very, very well, in fact. So I want to have these levels on my chart, because all the big guys are using them. Okay, and if all the big guys are using them, then you're likely to see price that's going to move to those levels. So I'd like to see what the guys are doing. Therefore, it's going to allow me then to tap into what they are doing. Therefore, I know that if I'm seeing price moving with long-term sentiment, then I know exactly where the guys are likely to be taking their profit, and that allows me then to have a better forecast on money management just going forward. It's vitally important. So now you can see that we're trading at a monthly fib level at the 23.6. You'll notice in the past it was a major support and resistance level to 2006, 2007, in fact. So this is going to, we're likely to see a bit of hesitation here to start with. But as I mentioned to you, we're going into a new month. There's a lot of data coming out this week. So it's bound to be consolidative, because you're going to see a lot of speculative trading coming in this week, heading into non-farm payroll. You're likely to see price becoming a bit volatile, a bit hesitant in its movement, because you're going to see a lot more speculative traders coming on board, speculating what non-farm payrolls are likely to be. There's a lot of interest rates announcements also that come in for other currency pairs, so you're likely to see hesitation at the start of every new month, because of the fact that we have a lot of data that comes out for that first week of every new month. So however, the bias I'm still looking for is to the upside, because everything's pointing up for the US dollar. So if I drop down to my weekly, you can still see the candlesticks are still very much positive. We had one or two red arrows, but it was just consolidation in an uptrend. Consolidation in an uptrend. Okay, blue arrow, bang, we're back in positiveness. We're back above, everything's above. However, I'm trading at a major support and resistance level. Now what I can say is, if price stays above the 23.6, stays above 112, then I should be looking for price to be supportive. So I want to see supportive candles, hammers, bullish aramis, those type of candlestick patterns to concur that price is happy to be above the 23.6, happy to still maintain above 23.6 fib, above the 11269. Therefore, you're going to start to see the building process happening, because a strong foundation leads to higher price levels. So my daily, you can see now, Friday, very, very positive candle, breaking the actual monthly highs, moving aggressively up into that level. And you can see on Sunday evening a very hesitation over the 2-hour trading period, but you can see prices still holding on to those levels. So the bias is still there for further highs for the US dollar. Let's hope and see if the US dollar has favorable news this week in terms of non-farm payroll. That's just really going to add more substance. Non-farm payroll figures, what are they expecting? Non-farm unemployment change, they're expecting less employment. Okay, they expect the prior figure was 2,480 jobs. They're expecting the forecast to be 229,000. So there's a good 19,000 less jobs, which is not a really good sign. The unemployment, however, is still not changed at 5.9%, which is important. As long as that unemployment change doesn't get any higher, and we want that unemployment, the claims figure, to actually drop if possible. Okay, we want to see that employment moving higher and the unemployment dropping. So it's vitally important that we see that for the US dollar to see any further positiveness. So holding on to those levels at the top here, as long as it maintains those levels, then on my intraday time frames, I'm looking for price to build on that. So you can see a lot of indecision candles now on my 4-hour time frame. A lot of spinning tops over the last 16 hours of trading, in fact. So, sorry, 8 hours going into the 12th hour now of trading. It's still above that 112. As long as it fails to make new lows, but it continues to attempt the new highs, that tells you the bias is still looking high. Therefore, we want to see ideally the 4-hour candle trading above that 112.98 and change level to make a nice bullish engulfing candle, which is going to engulf the last 8 hours of consolidation, and then we could look potentially to trade towards the next level, which is up here at 124. So there's a lot of potential profit between those two levels. There's in fact over 1100 pips to the next level. So we're seeing a lot of strength for the US dollar. There's a lot of potential profit on the table going into the end of this year. So keep that in mind, guys. Okay, so I hope you find that beneficial. I'll probably catch up with some of you guys on the chat. If not, if you are interested in what we do, please get hold of us at info@sereneeducation.com. The email address will be at the end of this video. Yeah, have a fantastic week as trading. Please be vigilant because it is the first week of a new month. There's a lot of data from Wednesday onwards. Very, very important. If you're new to trading, you don't want to be trading areas where there's a lot of indecisiveness in the market, a lot of speculation. It's different if you've been trading for years and you know how to utilize that volatility. But if you haven't traded before, the last thing you want to do is be trading it because you're going to have tight stops, because your money management won't allow you to trade with larger stops to accommodate all this volatility. And all you're going to end up doing is you're going to be shooting yourself in the foot because you're going to have losing trades after losing trades, and you're just going to get yourself into a lot of hassle. So far better just to back away. Look what price does, look what the data comes out, and that in turn will then have a positive effect on price action, and that's what you're going to be trading with long-term sentiment. So if US dollar is still looking positive for this week, we want to see prices making new highs. If we do get that, then we know that prices still want to moving higher, therefore November should be looking for higher highs. Vice versa, if price is dropping, we want to see price moving with negativity, we want to see negative news to then move price back into that long-term trend. And then you just capitalize on it with fantastic money management rules. Okay, I'm going to leave you with that. Been jabbering here for the last 27 minutes. Hope you have a fantastic week and trade serenely.